The November employment numbers are released on Friday, the last jobs report before the Federal Reserve's all-important December meeting. Here with what we should be looking for is Steve Blitz, the chief economist at ITG. And Steve, it's good to have you back. Welcome.
Thank you.
So give us a sense of what we should expect in terms of that headline non-farm payrolls number on Friday.
Okay. Well, we're looking for a number around 208,000 for total and 206,000 for private sector. Looking at the ADP numbers, which tend to be on average about 8,000 higher on average than the BLS number, we're pretty much on track.
And those ADP numbers was 217?
217, right? So take away 8, you're kind of like in our neighborhood for what we're looking for. I'm not sure whether or not the point forecast is all that important. I think what people really going to be looking for is some kind of a signal from the data to say the Fed will or will not go on December 17, the next FOMC meeting. And there, really, you need a payroll number that's probably going to be something above 150,000, which I think everybody anticipates it will be. And so it should be a number that adds to the general perception that the Fed will finally make its first actual increase in policy rates on the 17th.
But at this point, does it really matter what the number is? I mean, you have the markets pricing in a 75% chance of a rate hike. This is a Fed that sort of wanted to go in September but couldn't because of China and volatility in the stock market. You know, are they really going to let one bad number throw them off course?
No, but remember, we had two 100,000 employment kind of numbers in August and September. And then the average was in effect saved by this outsized 260-odd thousand increase in October. So if you got 100,000, and no one's expecting it, but let's just for argument's sake, say that you got 100,000 number for November. Now all of a sudden, October doesn't look like the number that made those prior 3 months, including October, an average that matched up with the average of where we've been.
Because October was 271. That was a huge number.
Exactly. So now if you get 100,000, it's like maybe October's the weirdo outlier, and maybe the economy has slowed down to the point where we're only increasing jobs by 100,000. So that would make them take notice.
And we also have a host of Fed officials this week saying, reiterating this point that, look, it's the pace of rates after the initial one that's most important here, not that first rate hike.
Right, and that's because they learned their lesson from a year and a half ago. If you think about it, the economy, they've actually tightened. If you think about it from the perspective of market pricing, they tightened a year and a half ago. And at this point last year, the market was pricing in about 2.5 tightenings by December. So those forward rates, which flow through into everything that interest rates in terms of where companies borrow and everything else, has already been in the marketplace, and the economy and the capital markets have reacted the way they normally do over the last 18 months after the Fed first starts to hike.
Right, and quickly, we're also going to get average hourly earnings on Friday. Anything to watch there?
Just to see whether or not they're picking up. And if they are picking up, I think it's going to say something a lot more about the jobs that were gained. In other words, is let's say it's 208,000. Are these high-income jobs or low-income jobs? And if there's a bigger increase in employment, in wages, it's probably because of higher income jobs being added.
All right, Steve Blitz, always a pleasure. Thanks so much for coming in.
Thank you.
I'm Scott Gamm, and you're watching The Street.